Welcome to The Riff, where writer and investor Bern Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
Let's start this week with why Amazon can get in the airline business.
Yeah, so Amazon's an interesting company. I do own shares, have owned shares for a while. I Part of what I like about them is that they sort of set themselves up to enter industries that already have acceptable returns on capital, and then they get higher returns than the average industry participant. So, warehouses, they're a viable industry. There are plenty of companies that just invest in warehouses. There are plenty of real estate companies, one of which we might talk about a little bit later, that own warehouses. And there are just there's like a strong investment case for consumption of goods is going up, and it gets harder to build things over time. So you want to own things that are at the nexus of that increase in demand and that restriction on supply. But Amazon can make more money than other companies from warehouses because they are monetizing not just the actual transportation services, they're also monetizing the purchases through ads. They're also monetizing that customer relationship through things like Prime. And now Prime has had a video bundle for a while, and now that video bundle has ads too. So like there's just a lot of ways that if a warehouse makes money, it makes more money when it's part of that overall Amazon umbrella. And you can make a similar argument about data centers, where the data center business does exist. There are independent companies that run them, and there are real estate companies that just invest in data centers. But you can make more money if that data center is part of AWS and it's part of this huge scaled system where like every single niche use case eventually turns into a product. That product gets loyal customers. There's like a compounding data moat where it gets harder and harder to leave as you have more and more of your data with that one company. So um, yeah, I sometimes ask myself, as I'm sure people at Amazon ask, like, as these businesses mature, as they start throwing off more cash flow that could be profitably reinvested, where does the marginal dollar from Amazon go next? They will occasionally buy back stock. They don't really like to. They don't see themselves as being at the point where they're returning most of their profits to shareholders like a typical mature company would. And one of the categories that is an interesting one to think about is passenger airlines. And what's cool about passenger airlines, and when I think it's important to restrict this. So um, there are many models of airline businesses, one of which Amazon actually operates in, which is cargo airlines. So if you have a product that is a high ratio of price to weight and a high ratio of price to volume, and it goes bad quickly, whether that's because it's fresh flowers or because it's a new iPhone that is going to be a couple days more out of date by the time it gets there. It'll be like a month more out of date when it gets to the customer if it's on a ship rather than a plane. There are a lot of products where it makes sense to ship them by plane. So that's one airline model. One airline model is the discount carrier, like focused mostly on leisure travel and on people who are visiting friends and relatives. And that's like it's an interesting model, but it's one where there's a weaker competitive advantage. Where I think the really interesting category is network carriers. So these are airlines that they have multiple classes in the cabins. They typically have a loyalty plan. That loyalty plan drives a lot of their economics. And what's interesting about that is that you can look at an airline like Delta, American, and United. You can say that there are these two pieces of the business. There is a capital light fintech company with really great margins and a long growth roadmap. And then there's this heavy industry company where there are a lot of fixed assets. You have to lever up to buy them. You have exposure to fuel costs. You have unions. You have regulations. You have all these annoying things. And sometimes people will do the thought experiment of why don't we just split these off? Why don't we just invest in the fintech and not the airline? But it turns out that these businesses are really, really tightly complementary. That the reason that fintech business works so well is that there are just lots of direct flights from New York to Chicago or New York to San Francisco or San Francisco to Shanghai or whatever. Lots of ways to get to exactly where you're trying to go as soon as possible. And the airlines are very much in the business of catering to people who have urgent flight needs for which the cost of the flight is just not a big factor in the economics. So if you think about it, there is this kind of paradox at work here where the airlines make their money from these very long-term relationships with companies and with individual travelers, but they get valued at a pretty low multiple of earnings. Like the typical mature airline is trading at a single-digit multiple of earnings, and that's been the case. Like when that's not the case, it's usually because they're not making money. So the airline, like their discount rate is actually very high compared to the lifetime value of their customer. So in effect, the market is telling them do not actually maximize the value of these customer relationships. And in particular, if say Delta has an opportunity to do something really really nice for someone who is flying in the cheapest economy seat right now, but 20 years from now there is a decent chance that they will be a road warrior, like a partner at McKinsey. They're traveling several times a month. They're always in the air, and they are, at the top of the loyalty tier. Like, um, if you discount that future revenue at a low rate, it can be worth giving them something extra today. If you discount that revenue at a rate that's appropriate to the cost of capital for an airline issuing equity, then you'd say no, it's actually not worth doing. Like the money today, the $5 or whatever from charging them slightly more, or from not giving them an upgrade, is actually worth a lot more than this future hypothetical revenue stream far in the future. Amazon tends not to think that way. They have sort of, it's not as if they're only playing long term games. Like they seem to play very very short term, like fairly short term to very short term games with the merchants. I think their view is like merchants will come and go. They will always have to sell on the biggest platform, and so as long as Amazon is the biggest platform, like if Amazon's take rate is 60%, you will sell on Amazon and you will give Amazon your 60%. But they do try to make sure that their relationship with customers, with the end buyer of these products, is really good. And they often do that at the expense of the merchant. So Amazon has really generous return policies. And typically the merchant is paying for a lot of the burden of that, which sometimes leads to really annoying things. Like Amazon can, there have been complaints in the past that you, you order product X from Amazon. There are multiple merchants selling it. Some merchant happens to be the merchant who gets credited with the sale, but somebody else's inventory got shipped to the customer, and whoever it was that stocked that inventory was not doing a very good job, had damaged products, and those products get returned, and the merchant who had nothing to do with this still has to eat the cost of that refund. I don't know how common that particular scenario is, but it is generally true that Amazon is playing a very very long game with customers, and they want to have customers who are continuously ordering more and more stuff on Amazon and spending more and more of their time looking at Amazon's media stuff. They want those customers in the ecosystem, and that relationship works really nicely with an airline model where you monetize this customer relationship over a very very long period. But also, when you think about why airlines have such a high cost of capital, the reason is that they go through these really annoying crises. Sometimes it's a pandemic, but not always. Sometimes it's something like a terrorist attack, or there's a recession that hits them right after they've made a large order for new planes, or it's an increase in fuel prices. And there is like, at one level, there is hedging just in the form of diversification. That Amazon's in a lot of businesses. It's okay for Amazon's long term model if, organic food is less trendy than it was a couple years ago, and Whole Foods same store sales are not doing that well. Like Amazon can weather that in a way that an independent grocery store couldn't necessarily in the same way. So there's the diversification benefit of just, if you have this kind of lumpy business that sometimes loses a lot of money, and you embed it in a larger company that can afford to subsidize those losses in the short term, then that business should get a lower cost of capital. But there's also just Amazon, like the one of the features of the airline business that's made it such a tough business is that historically, kind of pre-financial crisis, what usually happened was that as airlines got more distressed, their suppliers would really bully them. So the credit card companies would extract really onerous terms in order to give the airlines more liquidity, or Boeing and Airbus would let an airline delay the arrival of some orders, but they would demand like a much larger order later on. So it kind of made sense that if you own equity in an airline, there's always some chance that that equity gets massively diluted at the worst possible time. And so instead of owning 1% of this airline, you end up owning 0.1%, or the equity gets wiped out, you own 0%. So Amazon would be able to weather that. And then in some cases, some of those external shocks, they're actually things that Amazon can handle pretty well. So pandemic, for example, just destroyed demand for passenger air travel, of course, but it didn't destroy demand for planes. The planes were actually very much in demand because it led to this huge increase in demand for goods. So in at least that case, there's actually this nice built-in hedge. You can retrofit planes, as people were doing in 2020. They were retrofitting passenger planes, saying, okay, there's actually not a whole lot of demand for leisure travel lately, but there is a whole lot of demand to get goods to American consumers in particular as quickly as possible. and there are a lot of backlogs in other parts of the logistics system. So yeah, we'll put some more stuff on planes. It'll at least get to where it's supposed to be, and everyone will be happy. So I thought there was like it's a fun thought experiment, but where it gets tricky is, okay, how do you actually operationalize this? So one possibility you might think is, okay, Amazon should just start a passenger airline. Prime Air is taken by Amazon, but I'm sure they could come up with a good name given some time. And maybe they could do that, but the problem is, to start, like, you can start a discount carrier by just finding one route somewhere that is actually profitable. Usually it's not literally one route, but it's usually like they start out with this very sparse route map. Like Allegiant, basically their business was, okay, we will find places that don't have a direct flight to Vegas. We will give them direct flight to Vegas. Yes, it might be like Wednesday afternoon, but it's also literally the same price as a bus, and you're probably not taking the bus. So, it starts there and then grows from there. But if you're building a network carrier, you pretty much from day one, if you're competing with someone like United or Delta or American, you need like the full roster of, if there are two major cities where a lot of people travel for business between those cities, you need like a flight every hour or two for any time that someone would willingly be on a plane. And it's just really hard to get the slots, really hard to get the planes, really hard to build up the whole network. So what I ended up concluding from that, which was not where I started when I was writing it, but what I concluded was, okay, next time the airline industry goes through serious distress, there is some chance that they get a bailout like last time. And there's some chance that unions make concessions, or that lenders make concessions, or, that everyone manages to work it out. But there will probably be some point, in my lifetime and yours, where the big airline stocks are once again down 90% plus, and it looks like they are some of them are not going to survive. And the ones that survive, they will have issued a lot of equity. So the shareholders won't capture much upside. And I think we should just not be especially surprised if there is some sudden offer from Amazon to buy one of these airlines and just have the network. And then they have one more passenger touch point. They have one more product where they can do the cross subsidy thing of, you sell X cheaply because of the complement to Y, you sell Y at the highest price you can, and that's how you manage to pay for all the money you're losing on X. It gives them just one more degree of freedom for those kinds of things, gives them one more way to get more information about people. Um, Airlines today are full of screens, so it's one more place to target ads. And of course, if you're Amazon and you have, in my case, 20 years of first party purchase data, and data from my credit card spending on my Amazon Prime card, you know pretty much what to show people on those screens. That is what they are actually open to buying, and that advertisers would be willing to pay to show to them. So I think there's like it's it doesn't necessarily have to happen that way. It's possible that airlines have actually changed their business model materially enough, and they're like, pre-COVID, there was this narrative, which was probably true, that airlines are not as tough a business as they used to be, that they have consolidated a lot, they have more pricing power, they're also financed a bit more conservatively, so they are a little bit less likely to get just ruthlessly mugged when the industry goes through a downturn. But it's still a tough business, and Amazon has this comparative advantage at diving into tough businesses and making them work pretty well.
Yeah, it's interesting to think about when a company is that big, what kind of other, very difficult businesses it should get into. Amazon spent $1 billion acquiring One Medical. You could have imagined it could have spent, something like that on, or even less on a potential entrant into this industry. You could imagine it gets into the university space. There's a lot of like other spaces that you could imagine a company such as Amazon or Google getting into that kind of don't have anything to do with what they're doing today, but you can draw a line of how this is strategic.
Yeah, like at some point, Amazon just ends up being this kind of levered exposure to GDP and to consumer spending in general. Like at some point, the thing, like if you exist on this earth and you are earning money and spending it, at some point, Amazon gets a piece of that. And they are just expanding their surface area for that in all sorts of ways. And yeah, I think this is a fun way for them to do it. And I think it'll also be interesting for the airline industry to have a participant who is one of the major carriers and has some business model commonalities with the other ones, but just has a lot of other things that they can monetize too. I think it keep things spicy. I don't think such a deal, like getting such a deal through antitrust and everything, that's going to be hard. The airline, like on the one hand, the airline industry has consolidated a lot and is healthier for it. And in real terms, air travel does tend to get cheaper over time, so that's pretty cool. Um, But it's also true that Amazon's a kind of unpopular company. When you look at the price tag for these businesses, you're looking at like 40 billion to 60 billion, with as the current market cap's not adjusted for whatever premium you'd have to actually pay for control. That premium is probably different if they are deeply distressed, but there are some cases where there's a deeply distressed deal and the premium is actually huge because it turns out there are multiple bidders. And again, it's hard to say like who is the second bidder for a deeply distressed United Airlines or something. Maybe private equity wants to give it a shot. They've had fun in various capital intensive industries before, but it's yeah. The check now is big enough, and the antitrust issue is tough enough that it's not going to happen now. But it's I think a possibility that you shouldn't round to zero the next time oil goes way up, airlines are all losing money, unions are angry, and people wonder if the airline industry just cannot, like, pathologically cannot make money. Like, there's that point that Warren Buffett made a long time ago, where he said, if you're a far-sighted capitalist, if you saw the Wright brothers doing their first flight, you should have shot them down. That the airline industry at the time that he was writing had actually net lost money over its entire existence. Um, the airline industry did subsequently make money. He did buy a bunch of airlines and then sold them like in COVID. And I think that was a reasonable decision just because you're underwriting something totally different. Then you're underwriting basically how much political will is there for to allow airline shareholders to benefit from bailing out airlines. Like, yeah, we want to keep the airlines alive. We don't want America to be the only major country that doesn't have an airline sector. But we also, we don't you don't want to put a huge amount of your shareholder capital into what is basically this macro bet that there's minimal relevant historical data for. So I respect both decisions, and I think it'll be interesting to see how the industry evolves regardless, because it is like it has evolved into this more Amazonian model where there is a lot of focus on how can we minimize the marginal cost of what we're selling, but there's also a lot of focus on how do we identify the really good customers, and then how do we maximize the value of that customer relationship, often at the expense of other businesses. So the other side of the airlines making a bunch of money selling points is the people buying those points having to spend a lot of money on points in order to make the rest of their business work.
We'll get back to the conversation in a moment after a word from our sponsors. If you don't already subscribe to Turpentine's industry-leading newsletters, like our new daily AI newsletter, Emergent Behavior, or Media Empires, you should. But that's not what I'm here to tell you about. The platform we use to power these newsletters is called Beehiiv, and it's excellent. First of all, it was started by the same early team who helped build Morning Brew into a $75 million newsletter business. And they built Beehiiv to offer that same powerful functionality to anyone sending emails. From essayists to business owners, the platform is beautiful, their text editor is intuitive, and they help you scale your audience with custom growth features. Beehiiv has powerful tools to help you monetize your content. You can easily launch paid subscriptions or pursue an advertising model. The Beehiiv platform will even connect you to premium brands to sponsor your newsletter. Not only do we use them, but thousands of the top newsletters in the world also use them, like Milk Road, Blockworks, the Lindy newsletter, and so many more. Beehiiv's founder hooked up Moment of Zen listeners with a sweet deal. Get 20% off for 3 months with code MOZ. Visit beehiiv.com, that's BEEHIIV.com, to get started.
Speaking of massive entities, I want to talk about Blackstone real estate vehicle that Bethany McLean thinks may be a Ponzi scheme.
Yeah, so this one is a fun one. So this vehicle, it's BREIT. It is a private real estate investment trust. It's a huge entity, and it owns this diversified portfolio of real estate. And for a while, the pitch was this is a well-run vehicle that is picking real estate mostly in growth markets and is going to provide investors with a steady risk-adjusted return, and they will get liquidity not from being able to buy and sell shares on the open market, but they can put money into it and then they can redeem that money at the stated net asset value. And it turned out there's one issue with that McLean points out, which is that net asset value is actually something that is calculated by BREIT itself. So they're grading their own homework. On the other hand, they're also making a market in their own stock. So on the one hand, they have an incentive to make themselves look good. On the other hand, if they do actually mark their assets to much, much more than they're worth on the open market, then the optimal thing for any smart investor to do is redeem their investment, and maybe find some way to go short. You can't directly go short, but I'm sure if you are a sufficiently large institution and you work with banks, those banks have wealth management units. Those wealth management units have people who own some B-rate. Maybe you can find some way to get the economic equivalent of a short position, and then you buy other real estate assets on the public market to offset it. I'm sure people have looked into that. I don't know if anyone's actually doing it. So you've got this big private vehicle, and it owns a bunch of assets where it is telling you what it thinks they're worth, and you can redeem. You can tell them, okay, I want my money back, but it turns out there is a limit on that redemption. So they had this limit of I forget what it was, but it was like you can't they would not allow redemptions more than some percentage of their assets under management in any given month. And that actually does make a lot of sense for a real estate vehicle, that you just don't have day to day liquidity for office buildings, warehouses, data centers. Like there is a market price, but it's not, you don't just open an app and sell your $1 billion piece of real estate. It's a little more involved in that. So it does make sense that they would gate redemptions. And there was this period where people were sending in redemption requests, and BREIT was prorating them. It was fulfilling some percentage of them, but not all of it, and so you had to wait a while to get your money back. The narrative that was floating around at the time was, no, it's not a Ponzi scheme. They're just a lot of very levered investors who own a bunch of this and were losing money on other stuff, so they needed liquidity. So they reluctantly tried to redeem, and then they couldn't, and then they freaked out. And of course, if you believe that your redemption is getting prorated, if you wanted to redeem half of your ownership, but you think that you'll only get a third of whatever you ask for, then you ask to redeem for all of it. So um, those kinds of runs on the bank, they always look a bit worse than they are. And if there isn't some mechanism for slowing withdrawals, that does actually make them worse. But there's also the question of, okay, why else might someone want to redeem this? And one answer is BREIT, which again, it tells you its net asset value. It's telling you how well it's doing. It said it was doing really, really well compared to the rest of the real estate industry. So I think their stated returns over the last 3 years were 11%. And if you just invested money in a diversified portfolio of commercial real estate, you probably did not make 11% over the last 3 years. You probably end up with some office buildings. You ended up with some residential exposure in areas where the residential market slowed down. And of course, if you were borrowing money, you're potentially borrowing some of it or even all of it at a floating rate. So even if people are still paying their rent, you're paying a lot more on the mortgage. So you're losing out on that end. And BREIT's counter to this was twofold. One of which was they are in fact good at selecting assets. Like they were overweight warehouses and they were overweight data centers, and those areas have actually performed well. And if you look at the pure play warehouse and pure play data center companies, they're not up 11% annualized over the last 3 years, but they're doing better than real estate as a whole. Like they're break even to a little bit up. Um, so maybe that part is potentially defensible. The other thing is they said they did hedge their interest rate exposure. So at a time when everyone else has their properties being marked down because they're being evaluated against a much higher hurdle rate, if Blackstone had hedged that, then they do better. And the counterpoint to that is they do a lot worse in a falling rates environment. So I guess like the two ways to do, like two really broad ways to do real estate. One is, this is just a clever way to bet on interest rates. So you want to buy real estate when interest rates are really high, and then you make money as interest rates go down, and you can refinance some of your borrowings at lower rates, or just if you're borrowing on a floating rate basis, then you're paying less interest, and the present value of your future rent goes up. So everything's wonderful. And then the other way is you say no. Actually, it is just not a great idea. Like if you wanted to bet on interest rates, plenty of there are treasury futures for that. There are interest rate swaps. Like if you actually want to bet on real estate, you want to hedge out your exposure to interest rates and actually make a bet on things like, are we buying property in places where more people will want to live? Are we buying warehouses in places where more people want to shop? Are we buying data centers in places where there's going to be more demand for storing and computing large amounts of data? And that seems to be roughly what BREIT did. So when I looked at this piece, I saw the headline and saw the byline, got really excited because Bethany McLean had famously written this piece in Forbes or Fortune, one of the two, asking in early 2001, is Enron overpriced? And the piece went through all of the weirdness of Enron and how, okay, even if you take them at their word and say that they actually are good at making money, they are making money through like arbitraging price gaps in different kinds of energy and other things, and they are really good traders. Well, you compare them to other companies that have a reputation for being really good traders, like Goldman Sachs, and they still look like they are multiples more expensive than those companies should be. So, or than those companies were. So she has a good track record of spotting this kind of thing, and she's written several books that are good. But in this case, there wasn't really a smoking gun. There was like more detail and color around the bear case. There was this nod to the bull case of maybe interest rates were a big, like maybe interest rates and office exposure are a big reason that real estate did worse. And if they dodged those two bullets, then this is what you get. You get like you get equity like returns if you avoid the mistakes. Um, and it does, like, I kind of lean at this point towards that's probably roughly what happened. And I think that, you don't want to say this means that they are just the greatest real estate geniuses of all time. This means they did not have a particular factor exposure that worked against real estate investors in the recent past, but rates just, they don't trend in any one direction forever. So there will be some time, like if I'm right, there will be some time in the next couple of years where there are a bunch of stories about how B REITs seem like the latest and greatest and best real estate investor of all time. And yet, even when the rest of the real estate industry is minting money because rates are down, B REIT is underperforming. And that's again what you should expect. You should expect that if they are actually hedging their interest rate risk and they are being very selective on the kinds of properties that they choose, that there will be times when they are making less money than the industry because there's a bet that they are not taking that the rest of the industry is.
So, how popular do you think they will be?
Um, how pop? Well, they're an asset for high net worth investors, and high net worth investors, some of them really like risk, but a lot of them want some kind of predictable return that is not correlated to the market. Not because they are all running really elaborate risk models, but because if they wanted, a roughly 10-ish% return and didn't care about volatility, index funds are right there. They can just buy the stock market, never think about it again, and over long periods get a decent return. Over short periods, who knows? But if you don't want to think about your money all that much, index funds are a really good option. So um, and products like this, they're always trying to offer something different, something that is to some degree uncorrelated or at least correlated with something else, so that you can have a diversified portfolio. So if you're losing money in one place, you're making it somewhere else, and you're happy. Like a lot of high net worth people, like by the time they get to high net worth, they sort of have this sense of, okay, I'm there's an amount of money I will not be worth. Like there are going to be people who are much richer than me. On the other hand, I have kids, I have other dependents, I have charitable causes I want to support, and I know that if I just liquidated everything right now, they would get X. And so I want to make sure that if I don't liquidate everything right now, that if I'm still making some financial decision and haven't given everything away, that it was a prudent choice for me. And so there's a lot of demand for fairly low risk vehicles that are not necessarily super liquid, but that do generate reliable returns. So I think like that kind of asset, it's going to get more popular. An aging population is generally a population that is getting richer in terms of liquid net worth. Like your economic life cycle is that you start out with this balance sheet where your biggest asset is this intangible asset, which is your future earnings potential. And every year you convert some of that earnings potential into actual earnings. You convert a lot of those earnings into consumption, and then some amount is left over. At the end of your career, you have converted all of your work energy into either past consumption, which was fun, or to current savings. And so at that point, your economic balance sheet is actually smaller. Like you've consumed a lot of things, but your financial balance sheet is a lot bigger, and you're looking for places to put that money. And BREIT it's designed to be one of those places. Like it is not something that you would invest in order to get rich. It is one of the dozen things you would invest in to stay rich.
Speaking of equities, you wrote this past week about the relationship between preferred and common, and you've been thinking a bit about that. Why don't you share your thoughts there?
Yeah, yeah. So and it used to be that I think financial engineering in some ways has gotten more sophisticated. In some ways, it's gotten simpler because what people have started to kind of realize is that there's not a lot of demand for preferred stock. So preferred stock used to be this very, very common asset class where you had common, which pays this discretionary dividend. Like if the company's making money, common gets a big dividend. If company's not making money, common doesn't get any. So I'm talking like 100 years ago. Then you had bonds, where you get your interest no matter what. And if you don't, or not quite no matter what, because if you don't get your interest, then the company goes into bankruptcy and you, the bondholder, are now entitled to the assets. You're the residual claimant. And then it used to be that in the middle of that, there was preferred stock. So preferred would typically pay like a lower dividend than common paid during good years, but it would pay more than the bonds paid just in interest. But the deal with preferred was if the company made enough money to pay the dividend, preferred shareholders get the dividend before common. They're preferred. But if the company did not make that money, then either there's no dividend paid and that's it, or there's no dividend paid and the foregone dividend accumulates over time. So preferred stock is kind of halfway between common and debt. It is, you are you're entitled to more money when the company makes profits, but only up to a point, and then you don't get anything after that. So it was kind of like this middle risk asset, and we've sort of replaced it with other things over time. But what I think is useful, like it's useful to have preferred stock in your list of mental models about financial phenomena, because there are some cases where, in effect, the common shareholders in a company actually own classic preferred stock. So one example of this would actually be going back to airlines. There is this cycle where when airlines are losing money, unions are very, very concerned with job security, very concerned with preserving seniority, very much, they really don't want to be on the hook for all this money the company has lost. And when the airline is making money, the unions would tend to prefer that some of that money gets shared with them. So some airlines do more direct profit sharing than others. But in a lot of cases, when an airline makes a lot of money, the unions know that that airline can afford to pay them, and that if the airline is making all this money, there's so much demand, the airline really can't afford a strike that prevents them from harvesting that revenue. A lot of the costs are fixed, and that's like the ideal place to be a union member is at a company where um, if labor if your union does not show up, the company's revenue immediately drops to zero. But if you don't show up and you're not getting paid, the company's costs drop, I don't know, 30%. So most of the costs are the fixed costs of just operating an airline. And that means the unions have a really good negotiating position, which also means that shareholders, their upside is pretty capped. This is actually one reason that Amazon probably would be reluctant to own an airline. And so maybe you wait for Amazon's warehouses all to unionize, and then it's a much more sure thing. But yeah, they so in that sense, you could say that the union is sort of like the residual claimant on future profits, and or the unions as a group are residual claimants on future profits. In some companies, it's a different dynamic, but kind of similar in the end for shareholders. So there was a story in the Financial Times a week or two ago about Anglo American and South Africa. So Anglo American, huge mining company. South Africa has a more mining centric economy than many other places. And so what tends to happen is that when Anglo American is doing badly, it's Anglo American's problem. When Anglo American is minting money, then they start their suggestions begin to arise that they should be investing more of that money back into the South African economy, that maybe they don't pay enough taxes, and maybe they should hire more people, et cetera, et cetera. So, with a mining company, like you there is probably a legal document that says that they own this mine, but in practice, if you have an asset that is in someone else's country and they have a military and you don't, and they have a legal system and you are a company that's operating within that legal system, like in effect they own it. You are like this outsourced service provider who gets paid to monetize it, but you definitely don't get all the upside if things go well. And other places operate further along this continuum. So in Russia, for example, it's like property rights are very, very contingent on whether or not you are behaving in the government's eyes. And so again, like you can in that case own a lot of very valuable preferred stock, but you don't actually have equity in a country that does not have a like weirdly strong commitment to not just rule of law in general, but in particular to like preserving the sacredness of common shareholders' rights to indefinite economic upside. And in like an even broader sense, every company's stock, like it starts out as a call option when the company is new and hasn't done anything. It's just potential and it's overhead. And then eventually it evolves into a bond. If everything goes really, really well, you end up with a business that is very, very big, doesn't need that much incremental capital to grow. You know roughly what it'll make last year, which is pretty much what it made this year, plus, a little bit extra from GDP growth or something, or maybe some marginal efficiencies. But it ends up looking more and more like a bond and getting priced more and more like a bond. So every company, like every asset, it's somewhere on that continuum between far out of the money call option and T-bill, and that where it is on the continuum is not necessarily strictly related to the legal form of your ownership. In fact, this shows up in other places where if a company is sufficiently distressed, the debt actually ends up acting a little bit more like equity. The equity is an out of the money option. So if a company has $1 billion in debt and the fair market value of its assets is $500 million, then the stock, like in theory, if the value of the company's assets doubles and it doesn't go through bankruptcy and wipe out the common shareholders, then yeah, common stock starts actually accruing some of that value. But in practice, the asset that's most responsive to changes in the company's underlying value at that point is probably the debt.
I want to take the opportunity while we're talking about unions to reflect more broadly. Do you think there's a better sort of infrastructure or sort of structural mechanic that would better sort of balance out the power between labor and capital in a way that's like super aligned? Like some people have been promoting sort of UBI or UBI based on sort of the S&P 500 or something like that. Is there do you think unions are outdated and we should have a better mechanism, or do you think they actually serve a pretty critical role?
Like I think for any kind of legal structure that just allows people to cooperate towards shared ends, it's really tough to talk about it being obsolete because and there's this path dependent thing where the function of a union changes over time. The function of a union in the late 19th century was, you and your buddies at the steel mill. If there are enough of you, then you could probably beat up the Pinkertons instead of them beating up you. So that's very different from today. Like we just have fewer Pinkerton on union member violent incidents than we used to. So they serve a different function. I don't know. Like there's the obvious economic inefficiency, which is less about wages and more about work rules, which is just if you have a bunch of really, really narrow rules about what individuals can and cannot be asked to do and what work this person is allowed to do that this other person's not allowed to do, you lose a lot of flexibility and dynamism. On the other hand, those rules tend to exist because the union doesn't trust management. And that's usually for some pretty good reason. Like, usually those rules do not arise because someone wants to just be unusually lazy and unhelpful at the office. It's usually something like they have been asked to do a bunch of work they're not actually getting paid for, and management is always like chiseling away at their time and chiseling away, always pushing them to do a little bit more work, a little bit harder, and they just don't feel rewarded for it. So, like, it makes sense that unions would have come into existence. It also makes sense that as labor laws got tighter and as more jobs moved away from kind of assembly lines where it's like you and a lot of expensive capital equipment, and if you don't do something, then that capital equipment is worthless. Like in that case, unions have a lot of leverage, but in a field like software engineering, you just it Google is not super worried that if someone doesn't show up to work today, like that idle MacBook is costing Google a staggering amount of money. Like they actually care about the work. And so in that case, it does make sense to give people more variable performance-based pay to try to measure their performance. And as a sort of replacement for worker solidarity through the union, you've got company solidarity through the employee stock options plan. And that's a different kind of solidarity, but like it is healthier to be part of an organization where you don't feel like the people running that organization are your enemies and that there's going to be this fairly fixed pie and you have to fight them over who gets the last slice. It creates a lot of it creates a lot of economic inefficiency when people have that adversarial relationship, but it's never down to just one side. Um, and there's also, there are models that have worked in other countries, like the co-determination model, where not only do you have a union, but the union actually has board seats, and when the company is making strategic decisions, the union members are right there in the room deciding, if we close down this plant, it's not just that's good for our earnings next quarter, but it's also is that good for the workers and their families who are going to lose their jobs, and that gets you a different set of outcomes. And I think when you think about the distribution question, there is this natural capitalist instinct to say, like, if someone starts a company, they took a lot of risk, they are entitled to the rewards from that. But they are always starting a company within this broader context where you are also rewarded for starting a company in a place that has a very stable, well established legal system where you actually know what you own and you know that contracts can be enforced, etc. So like, I think it's never really binary, and I think it's also just going to be very very situational. So my guess is like the question of are unions good or are unions bad? It's like are corporations good or are corporations bad? Well, it's very dependent on which corporation you're talking about, and also dependent on what you actually want to do about it. Like, would I would I join a union? Or would I go to work for a company where I'd have to join a union? Probably not. But that is less about, unions are always bad and more like if I'm doing that, I'm truncating both tails of the distribution, but I tend to, I aim to be more of a person with power law distributed results. So I'm truncating the good parts. I'm truncating the interesting parts. And I don't want that. But maybe in a different context where my job is something I do from 9 to 5 and never think about otherwise, and where I want to do a good job, but I don't need to do a better job than that. Maybe in that case, yeah, union might perfectly suit my needs, but it's very situational. It's nice to have the setup because you also, it is true that the relationship between an employee and a company is just very different than the relationship between two companies or just two random people. Like, yeah, there's definitely a power asymmetry. There is the ability to exit that relationship, so it's not like you are stuck dealing with this company forever. You can just quit your job, but that is in most cases that's a bigger inconvenience to you than to your employer. So like maybe to the extent that there's a good like drop in substitution for what unions do well. Maybe it's more about increasing the liquidity of the employment system, just making it easier to find the next best opportunity, making it easier to benchmark your pay, and especially to benchmark like your quality of life at your job compared to other companies. Like the better you can do that, and the more you could say like if you don't give me a raise today, I can get exactly as much money as I'm asking for from any of these 5 other companies, and here's what I like about each of them. Like if you could say that, you know the union would be potentially convenient for you, but it's also kind of superfluous.
The as well. So I want to segue to a piece that you wrote on the New York Times, and you looked at New York Times evolution kind of in light of how media has evolved as well. But why don't you share some of the main takeaways there?
Yeah, so the high level media thesis is that there is this long cycle in media where sometimes there's a new form of distribution, and mastering that distribution model is all that matters, and you can repurpose or pirate all of the content that you need, and the content doesn't have to be good, it just has to be available in this particular way. But eventually that whatever that new distribution model is, it gets commoditized. Either everyone does it and there's no competitive advantage, or there are people who own the rails, own the pipes, whatever, and they are charging a monopolistic price, and you don't own those, so you don't have an advantage. And at that point, content matters more. And I think the New York Times is an amazing illustration of this because they went through this crisis in the 2000s, early 2010s, where BuzzFeed was eating their lunch, and there would be times where someone at the New York Times would spend, weeks or months reporting on something. They'd produce an amazing article, and then BuzzFeed would take a few screenshots, republish it as a listicle, get 10 times as much traffic. And they did that because BuzzFeed knew how to get traffic in search, and they really knew how to get traffic in social. So at that point, one thing the Times could have done is just get really salty and say, "This is terrible. These people are ripping us off." And the other thing they could do is say, like, "It is actually a lot easier to do BuzzFeed than it's a lot easier for the New York Times to copy BuzzFeed than for BuzzFeed to copy the New York Times." And if they both try to copy each other, what you probably end up with is a New York Times that's also really, really good at gaming social media and really, really good at getting search traffic, and then a BuzzFeed that is relative. Yes, they can get search traffic, but they're not going to get as much as the Times. And that is pretty much what happened. But there's been this new transition where now social doesn't really. I don't want to say it doesn't matter at all, but it doesn't matter at all. In terms of getting eyeballs to look at ads on news sites, social should not be a high priority for anybody because Twitter downranks things that have links. Very frustrating to me. That used to be how I got all of my signups, and now it doesn't really do much for me. Um, and Facebook doesn't want people talking about news because talking about news makes everyone angry and depressed. And so there's less traction for that. And then to the extent that there is discussion in social platforms of news, those platforms all want that discussion to stay on their platform. So they don't want it to generate much ad revenue. They don't want it to generate eyeballs and ad revenue for the media outlets. But at the same time, those media outlets have gotten more people to install their apps, and those apps do push notifications. They've gotten more people to sign up for newsletters, and those newsletters show up in your inbox along with all your other email. So they actually ended up evolving their distribution away from the distribution model that almost killed them when they didn't jump on it. They jumped on it, and then they managed to hedge. They managed to move on to the next thing. And it's it's possible to imagine those models also going away in time. I'm sure they will. At some point I will have installed the last app I ever install. But it'll be a while. And in the meantime, what the Times realized was that since they do own this distribution, they have more things to sell. They of course have their core news product. That's where the brand name comes from. But they also have games. They also have things like Wirecutter, where they're getting affiliate revenue from reviewing gadgets and things. They have recipes. And what's what I think is especially interesting, actually, about the games business in particular, is that games tend to be, you have a lot of people paying for games, like it is a huge media business, and then you have a lot of games that are supported by ads. And the New York Times audience, they definitely have the ability to pay for games. They're a high income, high education audience. They are also an audience because of those traits that advertisers really want to reach. One of the problems with marketing to like showing them ads in games is just convincing them to download a game. It is just harder to get the median New York Times reader to do that than it is to get the median Clash of Clans player to download Clash of Clans and play it. And they've for a long time had games, and like the crossword I think dates back to the 1940s. They've been doing that for a long time. It is much more of an intellectual kind of game than matching the gemstones or whatever. So they've been doing that for a while, and they've realized that that is just another avenue, and that in particular daily puzzle games create a daily habit, and that gives them this leading indicator of someone's engagement with the Times in general. And it just gives them basically every day an upsell opportunity to get them to subscribe to one more piece of the bundle. And then when you are selling digital products, you tend to want this maximalist bundle in many contexts. You want this maximalist bundle where it's more content than anyone could consume, but they can always find something that they want. And once the something that they want is like three different things from three different bundles that are each separately priced but can be bought all together for a lower combined price, then it's really hard for someone to churn. Like someone who is an all access Times subscriber, for them to stop reading the New York Times, they have to stop caring about world events. They have to stop caring about what's going on in New York City. They also have to no longer want recipes, and they also have to be willing to sacrifice their Wordle winning streak. And just every one of those creates this new barrier to exiting. And as the retention goes up, you're also getting more engagement, so you have more data on what these people are interested in. So you start to get some ideas about what would the next potential game be, what kinds of recipes should we do, and what should our coverage tilt towards. So it becomes this nice self-fulfilling model, and I think there's a lot to learn from it for other businesses that have a low marginal cost for shipping the next unit of whatever it is that they sell, but then have this question of how do we acquire customers, and especially how do we keep those customers loyal over time.
Do you think that the New York Times and media more largely mimics other industries impacted by the internet, where there's just an aggregator that gets bigger and bigger, and then there's long tail, like Amazon is the aggregator, and then sort of this long tail, or like is New York Times like the aggregator, or the business that gets the biggest, and then there's this kind of indie substackers or writers, but like most of the people who wish they were the New York Times, the middle is just dead.
I think it gets tricky because I think that within media, it can actually be a little bit misleading to compare a solo newsletter to a larger media conglomerate. And one of the reasons for that is just the solo newsletter is just not going to cover everything at a given level of quality. It's not going to cover everything at New York Times quality. It's not going to cover everything at USA Today quality. It's not going to cover everything at BuzzFeed quality. It's going to hit particular subjects really well, and then other things it's either not going to touch or not going to do a great job on. But what's different is that people, it's it's possible to develop like a parasocial relationship with a particular New York Times writer. This seems to happen more on the op-ed side than elsewhere, but it's a lot harder to do that with like the institution as a whole. Whereas with a newsletter, it's almost this natural process of like people who read the diff every 6 days a week, they're getting an email from Burn in their inbox. So they probably have other people who pretty much every day they're getting an email from that person in their inbox. It's a lot easier to see it as this actual one-to-one relationship. And at New York Times scale, you can't really have every writer answer every question that they get from that arises from every article they write. Um, it's tough to mandate that, and it would be kind of formulaic if they actually insisted on it. But with a newsletter, you can have that, or you can have a continuum where no, someone doesn't answer every single email, they don't respond to every single comment, but they do sometimes engage, and sometimes there are these long running discussion threads. So I think that for newsletters, the economic role is actually closer to that of a pastor, where it is someone who is like a central node in a community that's defined by some set of shared beliefs, but they're also defined by a regular ritual. And if you look at the Bureau of Labor Statistics data, there are more professional clergy in the US than professional writers, and they actually make more money on average because they do, instead of having this very small shot at getting a ton of attention from a gigantic number of people, none of whom have any one-to-one relationship with you. It is like pretty high odds of getting pretty good engagement from this small set of people, where the set of people you can actually reach is not going to change all that much. But it is a set of people who will be more likely to consistently come back. Like sometimes, today's issue wasn't really good, but they still like you, respect you, so they'll be back tomorrow to see if you've improved. And they will also email. This happens a lot, where someone, they didn't like a particular issue of the diff. They tell me so. They tell me why. But that I don't think I've ever gotten an email from someone who did that, like gave a ton of negative but constructive feedback and also unsubscribed. Like usually they give the negative but constructive feedback because they are going to remain a subscriber and they'd like to be a subscriber to a better publication.
That makes sense. The gearing towards closing, there's one more topic I want to get to. One was your piece on invisible efficiencies. There's and in general the idea of gains that can't be showed in the statistics, or how should we think about this?
Yeah, so this one is one that I've been thinking about a lot because I worry, as a lot of people do, about the slower productivity growth since the 1970s. I too wonder just what happened in 1971. Why was total factor productivity growth about 2% annualized before that, about 1% since? And there are various times where the numbers look a little bit better and we get excited, and then so far those haven't really panned out. But there was a really interesting piece by Tyler Cowen and Ben Southwood a couple of years ago that was looking at this question of scientific progress. And one of the points they made on measuring total factor productivity growth is that sometimes something that is actually a technological improvement, it shows up differently in the numbers that you use to get to productivity growth. So to take a step back for a moment, total factor productivity is one of those numbers like alpha, where it is the error term in a linear regression. So if you're doing a simple model of the economy, you can say there are two inputs: there's capital and there's people. And when you get more of either of those, you get more output. So if your population grows 1%, you have 1% more workers, they produce 1% more output. If you increase the stock of equipment, infrastructure and machine tools and cars and houses and everything else, you get about 1%, you get an increase in output commensurate with that increase. And it turns out that if you just take that model over long periods, there is this large and growing gap. There is economic growth that cannot be explained by either more capital or more labor. And we call it productivity growth because that's roughly what it is. But let's consider the example of aspirin. So suppose that there is some fraction of people who, if they have a really bad headache, they will probably not make it into work that day. And so, they call it sick. But for some of them, taking an aspirin, taking ibuprofen fixes things up enough that they can actually do what they intended to do that day and work. So you would think this is a new invention. It's an increase in productivity. But if you look at the GDP numbers, what you actually see is no, it's an increase in labor supply. And I think that something like DoorDash or Uber Eats, or DoorDash or Uber, it's that. It is an increase in productivity in the sense that it is easier to match someone who wants to get from one location to another with someone who, for some amount of money, will drive them to that location. Like that's a very, very hard problem to solve without some kind of big platform matching people. You have to do a lot of cold calling before you find someone who happens to want to take you from the office to the particular restaurant. So like it is an actual productivity gain. But what it shows up as is there's this influx of new workers in the economy. They or people who are working more hours because they're now driving for Uber, so they have more flexible hours. They don't have to worry about exactly when their shift starts or stops at another job that pays a similar amount. So in the productivity stats, that could potentially show up as a decline in productivity. because now you have someone like the person who is working more hours, they are earning less money. Now, maybe in the long run, there's actually a net improvement in productivity, which is okay, if everyone who is just if every 10x engineer, but only 10x engineers, DoorDash every single meal. Maybe they get an extra hour of work out of every day. Maybe that compounds over time and you get this huge increase in productivity. But when you try to measure that increase in productivity, what you see is, hey, software companies are getting more and more efficient. They are making more and more money. And also there's this increase in the number of low skill, low pay laborers. But what you don't see is that for some of those laborers, they were just not in the labor market before. And now they are. So it's a productivity improvement for them. I think there's something similar going on with a lot of fast food restaurants going kind of literacy optional for their ordering systems and for the backend system that employees use, where there's like you can explain things like how to flip a burger pictographically. You can have a timer that just dings and they know to flip it. And so there's a set of people who were not employable in that environment before, and now they are. And again, it's a productivity improvement that shows up as an increase in the labor supply. And I started to wonder about this because there was an article in the Economist and another one in the New York Times about industries that are not AI centric industries. One was airlines, one was utilities that are actually getting improvements because they're using AI. So one of the big ones was just airlines getting better at routing optimally to conserve fuel by applying better models to weather to figure out exactly what the route should be on this particular day for this particular plane. So that is a big win. It's an AI win, but what you would see, like the way that you would experience that is actually a decrease in the cost of a plane ticket. So when you're looking for the impact of AI on the economy, um, the temptation and like the shorthand that I would use is things like what is the ARR of the big AI companies, and that gets you to a number. But maybe the more impressive productivity output is actually as people use these tools, they get marginally more efficient at things they were already doing, and so you see like this general broad-based improvement. But some of it will actually show up as just an increase in the labor supply because some people were previously not able to work, or there was not really a job that was actually worth doing. And as the market, like as their productivity goes up, the market clearing wage for them to work goes up, and so bam, higher labor supply, but it's actually higher productivity.
As well articulated, and we are right on time. So let's wrap on this.
Alrighty.
Bern, as always, great stuff, and until next time.
Yes, indeed. All right. Next time.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Bern's excellent newsletter, The Diff, if you haven't already. Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.